Just like to thank everybody for being here today on this Saturday. So again, I like these kind of Saturday events. Markets are closed. We can kind of kick back. And what we're going to talk about today, we're going to talk about the markets, but we're going to talk about, selling options and how to go about that for, income, profits, and hedging, kind of a 7-step plan. And feel free to ask questions as we go. If I miss a question, a lot of times what happens, everything kind of scrolls down on the GoToWebinar. So ask again, and I'll try to make sure I get to your question. So that being said, let us get started. So a little background on myself. I've actually started trading actually back in the mid 80s. I was fortunate enough, out of college, I got a foot in the door at a company called Coastal Corporation. They actually had a training program that would, take you in and train you to trade at that point crude oil and oil products. They were a big, integrated oil company with big office. Houston, we had offices all over the place, and about 4 or 5 different refineries. So we were, supplying, the refineries with crude and then the product off-taking and things like that. So basically, they put me in a program that took me about 3.5 months down to one of their refineries at Corpus Christi, Texas. And that just to kind of learn the fundamentals, the foundation of oil processing, how it works. So bringing the oil into the refinery, processing it into the various products. So it was a really eye opener for me. And then ended up getting the shipping side of things on the shipping department. Learned all about the chartering, the tankers, and scheduling, things like that. Finally got into the cargo trading side and on the crude, and right just out of the get-go, they sent me out to Singapore then for a couple of years, and ended up learning to trade products out there: fuel oil, gasoline, jet fuel, and then all the different Asian crudes. So fantastic experience. And then about mid 80s, about 1985, I got a job to go to this company called Transworld Oil. At that time, they were the largest oil trading company in the world. It was Transworld, Fibro, and Mark Rich. So that was where things really took off. And because we were, really heavy, obviously, in the energy side, but then we branched out. We got into all the different foreign exchange, all the different futures markets. And so I spent about 17 years with Transworld, and 16 out of Bermuda, which was the corporate headquarters, and ran the international trading group then from Bermuda for 10 years. So that's where I actually started trading options back in about 1987. So we started selling options on cargoes of crude. So we're going to talk about option selling, strategies and things like that. And so after that, never looked back, and options have been kind of the main way to go as far as all the different trading that I like to do. So that was a little bit kind of a background of where I got my start and where we are currently today at Power Cycle Trading. So thanks for being here. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, when we look at trading is a business of probabilities. And to be a successful trader or investor, it really comes down to controlling your risk. And that's really what's going to win the game in the long run. So by knowing and better understanding how to manage and control your risk is going to make a huge, dramatic, and positive difference in your trading or your investing performance. And the best way to achieve this goal is through the use of options and option spreads. Now, why is that? Now, when we look at, options, the unique pricing structure and capabilities that they add, basically, really, when you start using option spreads, it really allows you to control the probabilities that you can then really tilt way in your favor. So when used correctly, option spreads are going to provide you very defined trading risk. They're going to lower your capital at risk. That's going to give you a greater trading leverage on that lower capital at risk. And they're the best for, hedging. So as far as any type of hedging, they're unmatched. And that's really basically how options were originally created. They were created as a, instrument for hedging. Now, step one, kind of in my process that we'll talk about, is know how option pricing works. So by knowing how it works, then you're going to be able to, maximize your option trading profits much better. Now, when we're trading options, the most important option factor is to understand the concept of time and volatility and how they impact the price of your option. So, when we look at the time component or time value, it's basically the extrinsic value of your option. So it's the premium that your rational investor or trader is going to be willing to pay over the current exercise value, that intrinsic value based on the potential to increase in value before it expires. Now, it's this change in the value of your option based on time decay. We can then measure it based on the Greek called the theta. Now, when we look at time decay, it's always going to work against the buyers, and it's going to benefit the seller of your options. Now, this is because option theta values are going to give you either a positive or negative kind of value. Now, if you're long a call option or a put option, those positions have what we call a negative theta value. So that's going to be that they're indicating they're going to lose value as the expiration draws near. So if it's not going in the direction you need, it's going to lose that time value component each and every day. Now, the other side of that is if you're short that call or short that put, that position is going to have a positive theta value. And so that's basically going to indicate that if the position is going nowhere sideways, you're still getting the value from that premium that you received and the time decay component that goes against it, and it makes it go down eventually to zero. So that's the thing that you can take advantage of, when you're selling options. Now, the other pricing component is volatility. And the implied volatility then is expressed as a percentage of your stock price. So this is basically indicating a theoretical 1 standard deviation move over the duration or the option cycle or series of the option you're using. So in theory, a stock should end up within a 1 standard deviation of its original price about 68.2% of the time during that option cycle. So this theoretical then probability or forecast of your security price range should be a part of your process that you use for selecting then, what option price or option strategy to use and your targets for your trade. Now, when we look at the value of an option, it comes down to that component of time value times the implied volatility times the underlying value or the intrinsic value. And then once you know these variables, then you're going to be ready to price out that option and know what the option premium should be. So here's a good illustration of how this can work for you, or kind of how you can visualize and see how it works. So here on this table, we're going to say, every Thursday we have a new weekly option series. And on that first day, we have that full time component. Okay, so we have time times the implied volatility times the underlying value intrinsic. That's going to equal the option premium. So the first day of that option series, say on a Thursday, we have 100% time in that option. All right, so now I'm going to plug in the, say, implied volatility of 300. So, and then we're going to keep the intrinsic value just constant of 1. So you can see how time and volatility affect the price. So in this example, we have 100% price the first day, implied volatility of 300. So our option premium is $300. Now we come on down, you can see each day that time value component is starting to go down or starting to shrink. Okay, it's decaying. And when we come back in, even after a weekend, you can see that time component now has been cut in half. It's half of it's gone. So half the life of that option value is depleted or decayed. So even if we jack up the implied volatility here to say 800, well, it barely pushes up the premium in this example to $400. Right? So let's say the implied volatility was only $200. Then you see your value of your option would only be $100. So this kind of shows you how time and volatility flow through to impact the price of your option. And at the end of the day, at the end of your option series or cycle, time goes to zero and the implied volatility go to zero. And so these components have decayed to zero. And so that's what you need to be able to be aware of and use these to your advantage, or at least know what they're doing when you're buying an option, how they're going to start decaying and impacting the price of an option if you're a buyer, or how they can potentially help you if you are a seller of options, and the different then strategies that we're going to talk about. So the second step is the secret of income using options. It's knowing how to sell in time. So we can actually then, trade time by selling time to take advantage of that option time decay that we talked about, or theta. So the other thing you can think of is, an option is like a coupon that's going to be, has to be redeemed by a certain expiration date or else it's no longer valid. So, you go to a grocery store or wherever, you get this coupon that says, you have to use it by October 1st or so, and then it's, not valid. So the options are the exact same way. So when we look at option theta, it's not going to remain stagnant. So it actually is going to increase, really start to increase as expiration draws near, and it's going to decrease as your options go more in the money or more out of the money based because of the extrinsic value component. So in fact, the effects of an option theta decay, they're going to be most pronounced during the final 30 days of expiration. That's where it really kicks in and takes off. So here's kind of a good diagram to kind of illustrate that. So when you go out, let's say we go out to 120 to 90 days out, the time decay or theta is going to be very, very small. You won't even actually, notice it. But then as we start getting closer and closer to that expiration day or day zero, you can see the curve that starts to slope and starts to tail off. When we get to about 30 days out, that's where it really accelerates. And then we've got, these weekly options that we can take advantage of this accelerated theta decay for different option strategies. Plus, on the weekly, certain ETFs, we have, daily option expiration. So there's a lot of really great creative ways that we can go about using options, especially option spreads, when we, look at the different time frames. So the step 3 then is trading the probability. So this is kind of what the market makers, or what I call the market maker secret. So it's what they don't really want you to know, and it's all based on these, Greeks and the different components of the implied volatility, standard deviation, delta. So let's take a look at a really good example. I will get to that in a few seconds, but first off, just when you think about broad markets, think about they have a tendency to kind of trend maybe 1 to 3 week cycles, and then they'll trade a lot of times sideways in channels for 70–80% of the time. So, in other words, the markets or whatever you're trading is never going to go straight up or straight down. We're going to have movements or cycles up, cycles down, and then we'll have a lot of churning in between. So it's based on this sideways price movement that, if you're looking at out of money option buyers, they're going to lose about, theoretically, it comes about to 68–70% of the time. Now, the market makers know these statistics, so therefore they tend to trade from the sell side because they want to put the probabilities in their, in their corner. So this is the professional money. So we need to really start thinking and understanding the markets like they do. And it really comes down to the math and the math of probabilities. Now, when we look at the option makers, they're using these mathematical market probability statistics for pricing the movement of an option to its expiration. So by knowing the probabilities of your underlying security or stock finishing within a certain price range at expiration, this becomes key to determining what options you're going to be buying or selling, and then which option strategy to use. Now, these statistics forecast in how likely it is that that option will fall within a certain option series price range, either up or down by its expiration. So this forecasting is what we call the implied move or the expected move of the stock. Now, this implied expected move then is a theoretical estimation of this one standard deviation move of your underlying security, by its expiration. So this is a really important thing to understand and be able to calculate and forecast when you're trading options, or basically it's going to help you for anything you're doing if you can know what the implied expected move is of a certain security based on the days to expiration. It's going to really help you for setting up targets and understanding, what the option market's telling you. Now, when we're selling an out of the money option, so basically one standard deviation out, you're going to start out that trade with a theoretical 84% chance of winning. So that's based on the math of these probabilities. So when we look at an option, we have what we call the option delta. And so an option delta is, if you have a delta of plus or minus 1, that's equivalent, basically you can think of it as 100 shares. Okay, so you have a delta of 1, that's equivalent to like you controlling 100 shares, that'd be 100 delta, okay? So then if you, let's say you had on this bell curve here, this is the at the money price, $500. And this 520 strike here is about 4% up or 4% down based on the expected move. So that's going to have roughly equivalent to like a 16 delta, okay? So 16 or 20 delta is this outside point, that's a plus 16. And then the other part of it, the other side is the 480. So that would be your minus 16 delta. So if we take, a delta of 1 is equivalent to 100 shares, and we sell the short strike 520 with a delta of 16, what that's telling us is that what's left, the reciprocal of that, is 84. So the way that you can look at this theoretically is using this to help you on probability. So if we look to sell a 16 delta, that has what you can say is that has a 16% chance of getting to 520, or there's an 84% probability theoretically that price will be below 520 at expiration. Or if you did the other way around, let's say you sold that short put at 480, then the probability theoretically is that 84% probability it'll be above 480. All right, so these are theoretical statistics, and these are based on the option, based on where it's selling, time, the price of the option at the money, timed expiration, and your implied volatility. So these all go into your option model, which we call the Black-Scholes model, and it spits out these different probability statistics that we can then use. Again, they are theoretical, but they're really super helpful. All right, so that's kind of the basics of how it works. Now, here's here's this thinkorswim platform. So this is showing you option delta and trade probability. So if we look at this example here, this is on Apple. So Apple here in this example is trading at $190. And in this example, this 5 July series has 28 days to expiration. So then if we look here, at the strikes here down the middle, you're going to see over here, you'll see that says delta and that says probability. That's probability out of the money. So if we look at that 190 strike, which is at the money, you can see that the delta is 52. So that's basically say 50. So that's like 50-50, okay? Flip a coin. So there's a 50% probability that price will be at 190 or below, or 50% probability of 190 or above, 50-50, okay? Now, as you go further out of the money, let's say we go down to this 215 strike, you look over here, you can see the delta matching up with that as a delta of 0.5 or 5. All right, so if you look then here at probability out of money, that says 95. So here's that delta of 1 or 100. The probability delta there is 5. So probability out of the money is that reciprocal part of it, 95, okay? So then two different ways you can look at it. So if you were, say, a buyer or seller of that 215 strike, the probability of it getting to 215, there's a 95% probability that price will be below at expiration. Or the other way to look at it is there's only a 5% probability that price will be at 215. And again, these are theoretical, but once you understand options and how they work, you're going to really find this to be a very, very helpful tool for you looking at and assessing probabilities really quickly for whatever trade you're looking to do. So very, very important stuff, and that's kind of really one of the first steps that you really need to understand and use. Now then, by using this probability analysis, it's going to give you a very useful tool then for determining price targets to trade against. And it's very useful also for setting your hedges. This is where it really comes in handy. When you have to make a quick judgment decision on, oh, wow, the market's going down or up, and I've got this position on, what can I do? We can use these kind of deltas to help us, look at the probability of, hedging, okay? So it's got a really great, aspect of, assessing probability risk. So based on the math of the probability analysis, you're going to see that approximately 70% of options that are bought will expire worthless. So based on the probabilities alone of that happening, it's a good idea for all traders and investors to also consider selling options as well as just buying. So by adding option selling strategies to your trading portfolio, it's going to really make a big difference and a positive difference in your trading performance when you're using these kind of statistics and tools correctly. Now, before I get too deep into everything today, I want to show you what I have coming up next weekend. So I'm going to be doing a full course next weekend on how to capitalize on these options for income, profits, and hedging. So it's kind of a master's class course that I'll be doing. It'll start next Saturday, the 14th, from 11 a.m. to 2 p.m. or however much time we need, and then we'll finish up, Monday the 16th from 4 to 5 p.m. or whatever time. Now I'm going to be doing a very good special here today, and so let me give you the link. If you want to take advantage of this great special, just use this link here, powercycletrading.com. You can see right here it says special. Click on this link that I just put in. So we'll go through this and then we'll move on, but click on that link, and this is going to pull up this drop down. Okay, so then you're going to see here, if you sign up here today, right now, today, you're going to get 15% off of the course price and the value of everything I'm, added to this course. So let me pull this out and show you what you're going to get. All right, so if you scroll down here, if you use this promo code small cap sell 15, okay, put this in, I'll show you real quick, sell 15 small cap, okay, you're going to use that code, promo code. All right, so come down here, and so you look at course package 1. These are all the things that you're going to get. All right, so we'll go through this in more detail a little bit later, but I wanted, in case you have to take off for a football game or whatever you're doing today, didn't want you to miss out on this. So we're going to do course package. There are 2 packages, course package 1 and 2. Then course package 2 is with the alert service. But here you're going to get the all new course, 4+ hour workshop that will start live next Saturday. It'll all be recorded. The price of the workshop is $197. The value of it is $1,600 based on my time and everything. Now, if you use that coupon or promo code of 15, you'll get this off, 50% off. So it's going to be $167. All right, but with this package, you're going to get also these additional bonuses that are going to be very helpful, with your trading. So you're going to get you're going to get 2 indicators, which I'll show you how they work here, in the the webinar today. But you're going to get my cycle reversal indicator, fantastic tool that I use for every trade. My extreme range band indicators, you're going to get them by Fibonacci price target mapping, the course that I just completed last week. You're going to get that. You're going to get 30-day trial membership to my trading club. And then if you do the alert package, you'll get this actually for 4 months. Then we'll do a follow-up Q&A, you'll get that, and option trading tutorial. So, here's the course price right here. With that promo code, you're going to get 15% off, so it's $167. Now you're going to get, basically this is going to be like an 88% discount off that. So come down here, you can see the full course value here, $197, but you use that promo code here today, it's $167. So let's take a look, and let me click on that so you can see how that works real quick. And we'll put in that payment link here. And also, if you want to get my indicators, those are available too for Thinkorswim, TradeStation, and TradingView. So come down here, and you see its course value is $197. And you can see everything listed in here, that you're going to get. Then come down here, your promo code, and put with small cap sell 15. Click apply, and you're going to get this for $167. Now, again, if you do want my indicators, you can see it down here. You can add that to your cart right there, and you'll get that discount code off that as well. So that's course package 1. And then if you want my alert service, which has been super good, touch wood, this is the Elite Open and Close Trade Alert Service. That's available in package 2. And you're going to get, this everything in package 1, but you're going to also get the alerts for the next 4 months. And that'll be a course package value of $597, but you put in that promo code sell 15, and you're going to get 15% off that. So we've had, we're running about a win rate of about 79% winning rate, and this is starting, the service back in 2018 through Friday. So we've had we've had 776 trades. We had 2 more winning trades this past week. Closed out 558 winners, actually 560 winners, 51 break even, 165 loser, 79% win rate. So that's kind of these are unaudited, but that gives you an idea of what you're going to get. So we get all these 5 trade alerts. I have 5 different types of alerts that I send out. You'll get those for the next 4 months, and you can stop and start your alert service when you want. So if you go on a vacation or whatever, business or whatever, And then you'll get the Trading Club Alert membership too for 4 months. This gives you access to my trading room, a lot of other things which we'll go through. And then everything in that course package 1, all the bonuses, plus on top of that, you get the alerts. So this whole package is $597. But if you use the promo code, you're going to get 15% off that. So it's going to be $567. So let's just go through there and I'll show you how that works. So typically we'll do 8 trade different alert services. You get my text alerts on selected breakouts, reversals, credit spreads, or it may be a counter diagonal, could be a butterfly or long condor, could be selective earnings trade, or we've been doing these monthly binary butterfly calendar pending trades. So these are the 5 different types of alerts that I send out. So when I send them out, you're going to get a trading guide, you'll get the entry levels, the option strategy to use. These are all listed and then archived. And then you'll get for the next 4 months access to my weekly Q&As, live and recorded, daily video newsletter, virtual trading room every day during the week, that's open, and then 60% discounts on all trading courses and software. So that's everything you'll get kind of in the membership plus the alerts. And then like I said, I have virtual trading room every day during the week, 9:30 to 10:30. We'll go into this in more detail, but this is kind of overview. So it's $597. But if you come down here, and again, just click there, and then put in that cell 15. You're going to get your discount off of that. So, and there's also 2Pay if you would like that. So put in cell 15. Click apply, and you get that knocked down to 507. All right, and then again, if you want to pay, click there. If you want the indicators, just add to cart there. And so that's basically how it works. So we'll come back and spend more time on that later, but wanted to make sure that you saw this and had the advantage to take advantage of it. All right, so use that link there, powercycletrading.com/special. So basically you're getting 94% discount if you use that promo code today. So you're getting this full course package of $2,800 for $167, or you can do package 2 with the alerts added to it for $507. Hey there, Paul. You're in you're in Kazakhstan. Yeah, we used to do a lot of stuff in Kazakhstan. Yeah, Transworld, we had a huge deal in Kazakhstan. Oman Oil Company, which actually I was a marketing manager of that as well. Yeah, that was an interesting place. All right, so that's what we've got cooking there. So please take advantage of it today. Now, let's get back into statistics and probabilities. So this is kind of what you need to know. Here's a really good example to hopefully explain to you, selling options versus buying and the benefits that you get, based on statistics. So first off, imagine you're bullish on Tesla, okay? So and let's say Tesla's trading at $198. Now, as a beginning option trader, so as a beginning option trader, you might be tempted to buy calls 21 days from expiration that have a strike price of $285. And you're looking at those, you're interested in them because you look at the cost of them, they're going at 16 cents. So that'd be like $16 per option contract. Remember, one option is equivalent to 100 shares. So 16 cents would be like you're paying $16 for one contract. So then if you look at that, you can look at it, and you do the math, you think that, wow, I could do a lot of these and make a potentially huge amount of money. So here's just kind of get a visual idea. Tesla's trading right here about 198. And then what you're going to be looking at, you're looking at these options that are the 285 strike right here where my pointer is, right? Now, this, when you look at it, now you're beginner, so you're looking at 285. What you're probably not realizing is that's 43% higher than where it is here. All right, so just kind of visually look at that. Now, if you were to go out and you bought 100 shares of Tesla then at $198, then you're putting out $19,800, right? Then you're thinking, but if I took that same $19,800 and I bought those, 285 strikes for 16 bucks, I could basically buy 1,237 contracts of those $285 calls. And then I would be literally controlling 123,700 shares. All right. So this is, some huge potential. All right. So you look at that and you're like, unbelievable. So then you think, okay, what if then Tesla does hit 285 within the next 21 days? And those 285 calls that you paid $16 for are now trading at $1.16 or $116 per option contract. Well, you do the math on that, you can see, well, then you would make $123,700,000. So this is kind of, the memes stocks and stuff. You look at GameStop and all these different things. This is kind of the leverage and potential that you have when you have these way out of the money calls. That's what you're looking at, right? But it is possible that you can get these types of returns. But at first glance, this leverage looks awesome, right? But don't let the glitter fool you, because not losing money is just as important making money when you're trading, or especially when you're trading options. Now, the one problem then with these short-term out of the money options is that you not only have to be right about the direction the stock goes, but you also have to be right about the timing, right? And this is what really ratchets up the degree of difficulty for these types of profits to happen. So to make that profit, the stock doesn't just need to go past the strike price, but it has to do it within a certain defined period of time. So in the case of the $285 calls on Tesla, you need Tesla to reach that 285 within 21 days to get that maximum profit, right? Now, it's this dual objective of having to be right on the direction plus timing. This really lessens that probability of an option trade being a winning trade when you're just buying options. So my trading formula really is based on trading higher winning probability type trade setups with tight risk management and looking at the probabilities of those trades. So in this Tesla option trade, you're basically wanting it to move more than 40% in 21 days. This is like 3 standard deviations, right? So normal price move is 1 standard deviation, 2 is getting extreme, 3 is very extreme. So there's not too many stocks can do it. I mean, it happens, but they're not many. So in all probability, the stock would then not reach that strike price and the options would expire completely worthless. So then based on these probabilities, you can see using the standard deviation, there is only about a 2% chance that Tesla's going to reach 285 by expiration. 2% chance, right? So you're basically taking a lot of risk, but if it works, you're going to get a huge reward, right? That's why they're so cheap. So in order to make that money on those out of money options, you need to be very precise on your market direction and timing, or you're going to have to be very, very lucky. So here you can see the normal standard deviation kind of ranges. Here's your normal would be 1 standard deviation, 2 is extreme, but 3 is just really, really low probability, right? And that's kind of what you're looking at when you're way out there on that limb like that, in that example. Now here you can see this kind of backs it up when you look at the statistics. Here again, here are the delta probabilities, right? So here's Tesla, 21 days from expiration, trade at 197. You look at the money, okay, here's your delta, 54. You can see the option price. Here, if you bought that 197.5 price, you're looking at $11 and $11.60, or let's say $11.50. So that'd be like $1,150 for one contract. But then you were looking way out here, at those 285 strike, and you see the difference here. There's $16 cents or $16. So a huge difference, right? All right, but then this is what a lot of people miss. The delta says 2, so the probability out of the money, 98% probability, right? 100, a delta of 2. So the probability is 98% probability. Price will be below that 285, or only a 2% probability chance to get there at expiration, where you get that full payoff. So then you look at Tesla, you say, wow, it only went to 238 during that 21-day option price, lifetime. So you were right about the direction that Tesla moved, but since you were wrong about how far it would go within that specific time frame, you're still going to lose. And that's what's always painful, those losing type trades, right? So here you can see it graphically again. Here's your option analytics, and you can see the risk profile of this. So this is that Tesla 24 March 285 calls. They're trading now at 238 on the 25th. Okay, so this is the expiration. So you can see these are the 24. So this would be the next day. So this is expiration. So they're trading at 238. So it did go up, but only to 238. So it's trading right here. So you got to 238, you didn't get to 285. And so you can see that you would have lost $19,792 if you had done, went out and bought 1,230 of those contracts at 16 cents or 16 bucks. All right, so that's the losing side of it. Now, it's there's the other side of the trade. So based on this trade example, a better goal for every trader then would be to select trades that are going to be based on what's going to give you the most consistent positive returns over time, and not just that one-time big winner. So to be consistent, consistency is then derived from making these high winning probability trades based on good, reliable data and the statistics behind it that give it that reliability. So where there's this big disadvantage, such as in this option buying scenario, you can just flip the side of the coin to the other side, and you're going to see an equal and opposite advantage to the seller. So the seller of those options has that huge advantage over the buyer for these out of the money. So the pros, that's what they know, and that's what they're taking advantage of. So as a seller, all the things in this Tesla example are the same, but in your favor instead of against you, and the probabilities are way in your favor. So the seller of those 285 calls brought in $16 per contract. And when he went and sold that option, the statistics, the winning stats behind it was a 98% probability based on those deltas and what I showed you. So 16 bucks times 1237, that's 19,792 profit with a 98% chance of winning. So those are pretty good odds. So this is why the professional money takes advantage of selling options for profit generation plus hedging. So here's the other side of it. Here's those 24 March 285 calls at 238. So the seller here is walking away with a nice profit of 19,792, and he went into that with a 98% probability of that trade working out. So these are the statistics and the math of probabilities that you need to be aware of and utilize in your trading. The next step is knowing then when it's time to sell. So that's when, I showed you earlier, again, here's the link, George, use that link there. And with this, you're going to get these two tools. And these are going to really help to know when it is time to sell. So with the cycle reversal indicator and my extreme range band indicator, these are two really great tools that I use for all the trades and help to tell us when it's time to sell. So here are a couple examples. This is just, looking at S&P 500, the SPX. So this is a weekly time frame. This is a current, and I'll pull this up. But these are my extreme range bands. These are based on the average true range. So when you get to this white band, that's the normal 2 ATR, and the blue is 3. So normal movements is to the white band, but real extreme is to the blue. Now here's currently S&P 500 SPX. So you can see we just had another reversal right here. See the purple arrow? We had a reversal here. So what I'm trying to point out is when you see this, look at these. Every time we've had the reversal, what happened? Price went down. What happened here? Price went down. What happened here? Price went down. All right, so the indicator is below here. This is where it's based on a kind of the indicator plus a moving average. When it crosses there, boom. Now the thing is, what's great about this, we can use this tool in so many different ways, but when we, this is a weekly, so when you start seeing these arrows pop up, one of the first trades that we'll typically do might be to sell an out of money bear call credit spread. So you don't have to be exact precision or exact perfect on your timing, because if you're selling out of money, we're taking advantage of that time decay, right? So even back here, you can see, now in the course, I'll show you how we use this tool. So you can see here, you've got this second reversal. Sometimes these come in 3. So the first reversal, a lot of times it may start turning sideways. This one just pulled back. but here you can see it turn sideways right here. Okay, so and this is weekly, so you could have sold out of the money here and go sideways, you still make money, right? Here's one, a reversal to the upside right down here. So these are the great signal to alert to a cycle change. Now that's the weekly, and then we'll drill down. Here's the daily. So you can see where we are. This was this happened just about 4 or 5 days ago. We had this daily cycle reversal here where my pointer is, and then we had another one right there. But the point is, look what happened to price. The reversal, price goes down, reversal, price goes down, reversal, price goes down. Here's a reversal to the upside, price goes up. All right, so I'll show you in the course. I'll teach you how these indicators are used, and we'll get those to you and set them up. So here's just another example, QQQ. This is just taken from this yesterday. Here's the weekly. So you can see here going back on QQQ. Look at that reversal arrow there. Look at these reversals there. The price went nowhere. So perfect place for selling. Basically, we'll start selling credit spreads or something like that. Here's the reversal to the upside. Here's on the daily right here. Look at that. Down she goes. Down she goes. Up she goes. Here's NVIDIA weekly. Look at this. Look at that arrow pops up. What weekly? Look what it did. Look what it did. Here, boom. So it's just a really great tool. Here is just kind of back up and I'll show you again. Here's NVIDIA. And look at this. This is on the monthly, but let's pull it back here to the daily or weekly here. Let's put it back to the weekly so you can see. And again, yeah, you're going to get these two indicator tools with the course package as a bonus. So here's NVIDIA. You can see that rolled over. That's the weekly that came on the 26th of August, basically. Here was another rollover on the 15th of July. Here's another one on the 17th of June. Here's another one right there, 25th. Look at it. So it didn't go anywhere, right? Basically, just nowhere. So that's a really great indicator tool that you're going to get that we'll use. So let's take a current market review real quick to kind of see where we are. And so this is what I call my top-down market analysis. So, back when I was running the trading group, the oil trading group, we didn't have all these great charts and technicals. We did everything that was based on fundamentals. So we would look at we'd take information from all our different offices and we'd look at the big macro picture. And then we break the picture down to, more of a long-term, then into kind of a medium-term cycles to see what we want to do, what our trading plan would be. But now what I like to do is just, once or twice a week, I'll start out with the big macro view. So that's going out to the monthly time frame. And you can see we've been in just an unbelievable uptrend, right? And so we're just right now starting to get here. This is an 8 exponential moving average. Look at this. We had cycle reversal here and here. Now, when we get these reversals, this is a really good indication that the market's starting to stall. So you can just see prior examples. So you can see, so here's 3, okay? So I talked about 3. So here's the first one. It goes sideways, right? And then it pops up a little bit more. But basically, look, it just goes sideways. When that third one hit, it really got hit hard. Now here's it to the upside. Now this is the monthly. So we've had 2. That's a very, very nice, not nice, that's a very ugly indication of what this market may be looking for. So what it means is it's starting to stall. It's starting to get exhausted. And then what you want to do is you want to look to, okay, where could it go from here? And that's where we bring in Fibonacci, price support levels, etc. So this will also be in the course as a bonus. You're going to get my Fibonacci price target mapping, which will go through all this in much more detail. So that's another bonus that you're going to get. So that's what we're looking at right now. We're still in the uptrend, but things are starting to stall out based on this really good tool. Now, if we break it down to the next, we're like 30,000 feet. Now we're going to, come down a little bit more in altitude, see what's down below. Look at this weekly cycle reversal here. Look at that cycle reversal. What happened here? Goes down. What happened here? Goes down. What happens here? Sideways, right? Here's a weekly cycle reversal up. All right, momentum is starting to shift down. See how momentum is starting to fail? This is my cycle 1 indicator, measure momentum. So it's running out of juice, running out of gas. All right, so that's the weekly. And then here's the daily. And this really got ugly this past week. And again, look at this indicator. This tool has just been so helpful. So look at this right there. What did price do? It didn't do anything, didn't go anywhere. It could have sold credit spreads up here. Look at this second one. Then it really started to drop. Okay, look at here. What did price do? Didn't go up, went sideways, and then the second one, down she goes. All right. So here's a cycle reversal to the upside. And then our momentum, look at that, negative momentum on both of my indicators that measure momentum. So with these tools, then we can forecast better, have an idea of better forecasting price direction. And then what we want to do is, typically I'll put in my Fibonacci levels, look at price resistance, support resistance levels. And also with the course, as the bonus, you're going to get my target mapping, which will show you how to do all this. So we just do a quick, Fibonacci, measurement. We've got the next support is coming down here, right about here, 50% retracement, call it 53.80 right there. And then if that breaks, it's down to that 618 right down here at about 530 right through here in this area here. All right, so things are not looking good. Looking for probably a move right into this area, maybe Monday, Tuesday. At some point though, it'll get a little bit of a bounce back. We would look then a bounce back to be looking to retrace short right there. That's the 50 simple moving average. So that's kind of a quick overview, but not looking really good right now. Let me get rid of this drawing tool here. You still see QQQ, no NVIDIA? Somebody said stopped out. No, the green candle. No. Okay, so the point is, we're talking about what I'm. If you were to sell an out of money bear, so what I like to do when I start seeing these signals, the first kind of strategy I'll look at a lot of times is selling out of the money bear call credit spreads, right? Okay, so think about it. So if you did, a bear call credit spread, if we'll talk about this here in a minute, but if you did that, you get the premium decay, right? So it doesn't even matter. So if the price goes right here, this green candle, you're okay, right? Now, if you bought a put or something, you may have been stopped out or whatever. But if you did a credit spread up here, no problem, right? That's one of the big advantages that you can then adjust your trading based on the different strategies. So that's what we're going to talk about next. Okay. Yeah, this is SPX. Did you want to see NVIDIA? Here's NVIDIA. So here's NVIDIA, stock reversal, momentum. There's a lot of other little moving parts to my indicators, but you're going to get the reversal indicator, and the other indicator you're going to get is the extreme range band. So what I like to do is put those two together, and it really gives us a great tool for looking at when price gets too extended to the upside or downside, and then combining that with the alignment with reversals. So it's a super great tool to use to tell us, when it's time to sell or time to buy. So a really great tool that you're going to get, as a bonus. Okay, so that's an overview there. Now the next step, step 6 is then, selecting the right option income strategy. So, in my opinion, one major goal for every trader should be to select trades based on, again, what provides the most consistent positive returns with low defined risk and not always the greatest. So I look at risk first, and then I look at the return on that risk. So I'm always looking at the risk first, and then I look at, okay, then what can I make based on this risk? And I know that risk first, so I know what I can lose, but then what can I make and what kind of return does that give me? So, one way to achieve this then is by knowing the best option income type strategies that are out there and available to you, how they work, and then selecting the one that's going to be best suited for your trading style and the market that you're actually trading. So let's take a look at some of the ones that are kind of key, okay? So we're going to talk about the vertical credit spread. So this would be the one, again, that we might want to do when we get the first signal. We sell out of the money, or you sell out of the money here. So that's why these indicators are great, and that's why I'm including these two indicators with this package that we'll be doing next week with the actual course. And then there's another one we call the iron condor. There's another one called the long condor. Now these are totally different animals. And then we've got what I call opportunistic hedge trading management. So options were, originally, put together as a derivative that you can use for hedging, and a lot of people just, kind of don't realize that, and they just think options are, a way to, take leverage. But we're going to talk more about hedging in the course as well. So here's just kind of overview of a vertical credit spread if you're not, familiar how they work. So there are basically three types. Okay, you've got what we call the bear call credit spread, kind of a bearish, kind of bias. And there's the bull put credit spread, and then the long iron condor. So when we look at the bear call credit spread, it's going to be one that you're going to use when you think the market is probably going to go down. Okay, and you can make money over time even if the stock stays stagnant. So again, we were looking at that. We were looking back here. I think what were we looking? Here's like NVIDIA just again. So we get these reversal arrows, and the price starts doing nothing, right? It doesn't, it pretty much topped out. Okay, so that gives us an idea. Okay, we're seeing some exhaustion. This is the perfect scenario for maybe a bear call credit spread. So you can make money over time, even if the stock stays stagnant. So it doesn't have to go anywhere. So basically, we're selling a call while at the same time buying another call at a higher strike. So we're not selling naked. I don't, teach or advise anybody to sell naked. So we always do anything that I'm showing you, or things that we do in the trade room are always going to be a spread. So you're going to have your risk defined. You're not going to be naked short a call or a put. So here's, a vertical bear call credit spread. And this is what we call a negative risk ratio type trade. So in this example, you're short this 10-20 call right here, okay? So this is like was on the NDX. So that had about a 20 delta short strike. All right, so again, think about it, 20 delta, we look at our trade probabilities. So you're starting out theoretically with an 80% probability that price will be below that 10-20 strike. And then you're long right here, 10-30, so your cap, your risk. So that spread then is, the spread here is $10 wide or $1,000, right? So with this trade, brought in a credit of $200. Now the risk then is the difference. Your potential profit is your premium received here of 200, but the risk is the difference. So you've got a potential to lose 800. So you're putting up $800 in margin to make 200. So that's a 25% return. So that's what we call a positive risk ratio trade. I mean, a negative risk ratio trade. So you're basically risking $4 to make $1. So you're thinking, well, why would anybody do that? Because it's based on the potential probabilities of this not, being so far out of the money that you're starting out with a high probability of this going nowhere. So that's theoretically, a great setup when you're looking at, possible getting exhaustion, things like that. All right, so that's kind of one of the first trades that you can go to, strategies that you can go to. So here's an example on SPX. So here it is, comes up here, it's trading here. Here it is, starting to get, this is the weekly. It's getting really stretched out over that the blue line. That's extreme getting stretched. And then we had a cycle reversal here, so set up a bear call credit spread because we didn't have to be perfect on it, so we sold out of money. So here's where it was trading at, set it up on the 10th, and it ended up taking profit. It came off really fast 2 days later. So set this up on the 10th, it was trading at 51.64. So went out and sold the 52.65, bought the 52.70 bear call credit spread. See, so the short strike, that 52.65, when this was set up, that was a 17 delta. All right. So that's like, theoretically, you started out with an 83% probability that price is going to be below your short strike at expiration. All right, so set this up, and then the thing collapsed real fast, so we just went ahead and, bought it back. So, closed it out, brought in $1 or $100 per spread on that, And then when typically we'll take 80, 70% of the profit, just go out and go, down the road. So close this out, when it got dropped to 30, bought it back, so made $70. So that was a 18% return over 2 days. So that's a probability trade, starting that out with an 83% probability going into the trade. Now, the other one is the opposite, which is a bull put credit spread. So this is going to be one if you think the market's going to go up. So it can make money over time, even if the stock stays stagnant. So you're basically selling a put at the same time, buying another put with a lower strike in the same series, okay? So covering your downside. And so again, this is a negative risk ratio trade. It's also a probability trade. So this is an example, on Apple. So this was selling the March 149 put right here, okay? So you're short a put. So this is kind of a bullish strategy, but then you're long this put below it at 144 down here, okay? So it's a $5 wide spread. And so the spread width is 5. Now, this was bringing in a premium of $105. And so the risk is the difference of $395. That would be your margin. And your premium is what you're going to receive as far as your premium is your profit. So that'd be like a 26% return. So these are normal kind of returns on these types of trades where you're, these probability trades. So in this example, you're risking $3.76 to make $1. All right, again, these are kind of very standard trades that I like to look at when we get these types of reversals, either up or down. So here's an example of I'll put this on a daily, you can probably see it on NVIDIA. So right here, see that? You could have, sold an out of money. This is a great example, selling an out of money bull put credit spread below, right? It's telling you directionally that this thing has a high probability of turning back to the upside. So the first trade might be to sell that. And then even if it goes sideways, you're still going to make money. Okay, so that's how we're going to match these tools with the strategies, and that's what we're going to be covering in the course. So here's an example on AMD. So similar situation right there. It was trading down here. We got the reversal here. Boom. So sell a bull put credit spread out here. Maybe it churns sideways. We still make money, and then it takes off. So this is one strategy that you can apply. And here's the AMD trade. Sold the this was a 20 delta on the short put. So sold the 95, sold the 77 put, bought the 72 put below it, brought in $95. All right, and then went ahead and covered the trade when it was down to $4 or 4 cents. So at $91 per spread, that's a 22% return. Okay, so that's a bull put credit spread. Now the next one is what we call the iron condor. So this is basically where you're combining the bull put credit spread and a bear call credit spread together. And so this is great to use if you feel the stock that you're looking at or security is going to trade in a kind of a range, a tight range between two strike prices and stagnate there, not go anywhere. So it's a good range bound type trade setup. Plus we can leg in, leg out using this strategy. So the long iron condors then is ideal for premium collection to see potential premium and minimize your losses in the event the stock does move against you. So again, this is going to take big time advantage of time decay and volatility crush on your option into expiration. So here's an example of one that we set up on Tesla, an iron condor. So this is going to be, and this one we legged into. So we started off this one, we started off with a bull put credit spread. You can see where it's trading right here. Tesla's a really good one for these types of trades. So it was trading right here. So we started off with a bull put credit spread when it was down on the lows here. And then when it moved up here, we sold then the bear call credit spread and legged into it that way. So a lot of different ways that we can do it. This is how we did this one. And so here you can see the first part of the trade, again, this was on the 14th, it was trading at 243.30. Went short the 237.5, 235 bull put credit spread. And again, it had the short strike was a 20 delta. And so let me kind of line this up. So we were short that 237.5, bought the 235, okay, right here. Okay. And then we ended up with the brought in $60 there. Now this thing dropped down to 14, so could have covered it there, and you would be at $46 or 24% return. But what we did on this one, well, when it moved up, then we sold against it the bear call credit spread. So when it had that push to the upside, and it was trading at 253, we sold the 267.5, 270. And that was that 267 short strike. Then at that point, it had a 23 delta. So that was just, if you want to match it up, that was a 77% probability, just showing you those probabilities. All right, so you put the two together. So now we've got these two spreads and we combine them together, and this creates the iron condor. So we had that short, the 267.5 call, long the 270. That short strike had a 23 delta. We had sold originally, we sold the 370.50 and the 235 bull put credit spread 20 delta. Total of all the credits together is $98 per spread. So if you so here's what it looks like. If it goes out in here, you're going to keep the full amount of your spread at $98. Your total risk then is the difference. Let's say, you can see it's a $2.50 wide spread, right? So you're bringing in 98. So you've got your spread margin is 152. If you keep the full premium, that's a 64% return. All right, so that's a great way to kind of chip away and make good probability trades and wait for a range bound trade to take advantage of it. So here's what it looks like when you put it together. So here's your short your bear call credit spread here, right? When it pushed up, originally did the bull put credit spread first. All right, so the two premiums collected together, 60 and 38. So we had a 98 total premium on a risk of 152, went out right here, perfect setup. So we actually closed it out early, bought it back, bought the credit spread back, the puts credit spread at 4, and bought the call credit spread at 3, so made $91 or 60% return. So that's what that looks like. Now, the one that we do a lot of, and this is one that we do a lot of the next one. These are long, what we call the long condor. So let me look at the question. Do you have a collective index of all the option trades? Yeah, I do. Question is, do you have a collective index of the trades and how to, when to use them? Yeah. So basically, the course will go through that and show you when to utilize these different strategies. What's the best trade environment for, say, a bear call credit or an iron condor or long condor. Now this is the long condor, not to be confused with an iron condor, and this is one that we did on Google. So to show you this, so we're combining different spreads. On this one, we're combining a debit spread with a credit spread to give us really good defined risk, but a much higher positive risk ratio, not a negative risk ratio. So here was Google. It was trading back in June. It was trading at 179.50, and we bought it right here. So you can see the chart set up right here. These were based on our indicators right there. Positive momentum, cycle reversal right here. So we bought it right there, and then we had some profit take right there. No, we did adjustment here and the profit take here and there. Okay. So then on the 27th, it was trading at 185.40. So here it was trading at 179.50. We had some profit take on the 27th and more on the 28th the next day. All right, just kind of walking you through this. And so what we did on this one was the long condor, which is the defined risk, but also gives us a big, nice positive return. So this, if you look at the trade and pair it up, you can see this was a combination of a 180 call long, 182.5 call short. So there's a debit spread, and then we combine the credit spread side, the 185 call short, the 187.5 call long. Okay, so these two match together creates the structure here, which is what we call the long condor, not a iron condor. So this is a debit with a credit spread. So the potential risk here is $72, 72 cents, $72. Now the potential profit is your spread width. It's a $2.50 wide spread. 180, 182.5. Cost of the trade, 72. That's our debit cost. That's the max that we could risk, max that we can lose. Now, if it goes out in here, we keep the potential profit as $178 per spread, 247% return. So this is much better than if you look at the Iron Condor, you might make a 60% return, right? So just a different animal in different places and different times to use these strategies. And that's what we're going to be talking about, and going over in the course. So that's what the risk profile looks like. And then here's where it goes out. So this is the trade in at expiration. This was on the 28th, which was the day of expiration. It was trading right there. Okay, so, we'll take profits on, different levels, but here's where it was on the 28th. It was trading at 182.29. And so that spread went from the spread entry was $72 right there for buying this Condor. And then the spread blew out and widened to $2.43. So here's your profit. We ended up with $171 per spread, 237% return. So if you did one spread, you make, 171. If you did 10, you make 1,710. The Iron Condor, yeah, you could have let the options expire worthless, but sometimes there's, there might be a trade number coming up. So the question was, I believe the question was on that Iron Condor on Tesla, what you could have just let it expire worthless, and that is the case. But sometimes, you just, if you can cover it back real quick, you're out of the trade, no risk. If there's some news story comes out, things like that. I can't remember on that trade, but there could have been something coming up the next day, and you just want to be out of the trade. Okay, so it does for the, so I think, for example, Tesla had a chance to make $98, right? Okay, and we took it off on that example for, I believe, 93 or something like that, right? So sometimes it's not worth staying in it for the extra $5. Just, who knows? It could have been some, headline or something might come out. It could, I don't know at that point in time what was happening, but there could be some things that were coming up that we want to make sure we're out of trade. So for staying in it for another $5, it doesn't make sense when you look at your risk reward. So just sometimes it's just best just close trade out and go on. Just be happy with the trade. And also, yeah, free up your capital. Good point. All right, so that's a long Condor there. Hold on a second. All right, so now the next thing we're going to talk about is what I call opportunistic hedging or risk management. And here's an example of how this is done. So this was a trade that we had set up. This was a QQQ long put debit spread. Okay, so it was originally set up to take a downside move, and then we were able to adjust it to a free trade. And we did this by adjusting it into a put Condor. All right, so when we set the trade up, it was trading at $365. And then that was on the 28th. And then when the market, you can see kind of what happens here. What I look at is here's where we started the trade right here. Okay. My tool, let me get my tool. There it is. Okay, so it's trading right here. And then, I like to look, always talk about, if you like to play cards or chess or whatever, thinking two to three steps ahead. All right, so, we had the short trade here, but there was good support, down in this area. So the trade was, okay, if it hits down here, a lot of times you get these snapback rallies. So what we've been doing is when we get a big sell-off, then we can adjust the trade and make it sometimes a free trade or lower the risk by selling it out of the money. In this situation, bull put credit spread to offset the debit spread from the put debit spread side. Now we currently have a trade on right now, which we'll look to do that on Monday. We have a short trade on SPY, which is the short put debit spread, and that's what I'm going to be looking to do on Monday on this trade. So this one is what happened then on the 1st of October. It collapsed down here. It was trading down at 354.53. So we sold a bull put credit spread out of the money, and we were able to collect from the credit enough credit to offset the debit cost of the trade. So it makes it into a free trade. So here was it, if you break it down by trade, here was trade one. We originally had the long put debit spread, 264, 265, hold on. Okay, so we originally had this trade, and it cost us $121 per spread right here. See that? All right, so nice put debit spread width $4, so 400. And now if at expiration it closed, below that short strike of the put debit spread here at 360, we would end up making $279, 230% return. So risking 230 to make $1. Now what happens a lot of times, upside or downside, you'll see a big sell off and then a bounce back, or a big spike up and then a pullback. So what we've learned over time is that, we might have in this situation a put debit spread, then it collapses. We can lock in and take, take advantage of the collapse, bring in credit to offset the debit, and then we can sit with the trade. We just have a free trade. Then we don't really have to do anything. If we want to take it, we leave it, and we can see where we can maximize it based on our having zero risk. So then it collapses down, and we did trade two, where we ended up going short the 354 put, long the 350 put. We brought in $141 credit. So that offsets the debit costs of 121, and we've actually now have a credit. So if the market goes up or down, we're still going to make 20 bucks. And then if it goes anywhere in between here, we have max profit. We have zero risk. So here on the first, then it was trading at 354.53. This trade was up 152 plus the credit. It was up $172 on zero risk. And then at expiration, it was max profit up here at 420 on zero risk. So this is what you can do, when you combine these and you understand when to do it and how to do it. And then if I get rid of my pen. So these are really cool trades. So you can see we had a credit of 20, we ended up here, and potential to make $420 max profit on zero risk, or actually a credit of 20 bucks. So, if you like to learn how to then master these kind of selling option strategies for income, profits, and hedging, that's what we're going to cover next week in this course. So this will be next Saturday, the 14th, and we'll start at 11 a.m. to 2 p.m. or, however much time it takes. And then we're going to finish up and use this link here on Monday, the 16th at 4 to 5 p.m. or, whatever it takes as far as time. So, I typically always go over because there's questions. I answer questions as we go. So with this, it's a 4+ hour, live course. It's going to be all recorded. With the, it's $197, but if you use the promo code SELL15, you're going to get this for $167, SELL15, put that in there. And if you want with the alert service, you put in the 15 off, you're going to get that for $507. So you'll get all the additional bonuses here if you, use that promo code. And so 4-hour course, $197, but use the course code I gave you, that's SELL15, and this will be $167. And you're going to get all these tools. Now we're going to use all these in the course. So these are, come with the course. The reversal indicator, extreme range band, just completed this Fibonacci price target mapping. Very important to understand how to map out your targets for profit and defense. Then if you do this package, you'll get a 30-day trial membership. You can start whenever you want. And if you continue, it's $97 a month. Then we'll do a follow-up Q&A. That'll be on Tuesday. And then we'll have, I'll give you another kind of small option course, my option trading tutorial. You'll get that. So, everything combined, all the bonuses, $2,800. $197 is what the price will be this week. But for today, if you use that promo code, you get it for $167. So that's a great deal, obviously. And then if you want this with the alert service, you can have everything in package one, all the alert, all the bonuses, etc. But you're going to get my 5 trading alert services. You'll get, and I'll send these out based on the market, so based on what's going on, and I'll send out what I think would be the best option strategy for the setup that I'm looking at. So it could be a butterfly or long condor, could be a counter diagonal, could be a monthly butterfly pin trade or a calendar pin trade, could be a breakout reversal credit spread or debit spread, could be an earnings trade. So this is the different 5 selections that you can get. And so with this one, you'll get everything. This will be 507. Just use again that cell 15, and this will drop that down. I believe it's 507. So you'll have all 5 of the alerts, typically 8 to 12 stocks or ETFs over the course of the month. And the different 5 alerts, we'll go through some examples to show you. When I do the trade, a lot of members just want the trades and they just do their own thing, but I'll always give you a trading guide, an option trade that you can use. But some members just, they just want the trade, so they'll just, go long the shares, or maybe they go long calls or puts, whatever. But I'll always give you an option spread trade you can use. So then I do a trade setup video review after the trade's done that later in that day. Trades are listed and archived. And then we do weekly Q&As, which are live and recorded, so you'll have access to that over the next 4 months. And again, you can stop and start when you want. Then I do a video newsletter every day after the close. And then if you do just package 1, you'll get all this for the next month. And then if you do want to renew, you can do that as well. If you just do a monthly type thing, you can do month to month. And then I have a virtual trading room. So this is a really help for all members. So this is open every day during the week, 8:30 to 9:30, Central. And so come into the room if you have a problem on a trade or see what we're doing in the room. And then everything on my site, you'll get a 60% discount. So you'll get a members code, and then you put that into, if you want to buy another course or software or whatever, and that'll give you 60% discount off of that. So a lot of really good stuff here in this offer, and make sure to take advantage of it. So that's what you get. And again, use that special link there, powercycletrading.com/special, and that'll pull up everything you need there. Let me just show you one more time. If there are any questions on that, let me know. So just pull up that special link there. Then come down here, make sure you use that cell 15, get that extra 15% off. And then if you do want the indicators, you can add those to the cart. And I have them for Thinkorswim, TradeStation, TradingView. So just click that buy link. And if you do want the indicators, you can add those to the cart. You'll get, everything will be 15% off. So you can get the discount on that. Okay, and then if you want the other package though, with the alerts, just do the same thing. Just go here and then put in that cell 15, and you'll get that additional 15% off. Now here, let's go through, I'll show you some other alerts that we've done. We've had a really good few months here, but actually we've had a really good number of years. So these are unaudited, but just gives you an idea of what we've done. So started the first alert service back in 2018. The first one was breakout and reversal types, and then I've added different ones as we went. But through yesterday, we've had 776 trades closed out, 560 winning trades, 51 break even, 165 losers, run at 79% win rate. Again, unaudited, but these are kind of the summary results. Okay, to see how we've been doing, and that's over a number of years, as you can see. And this was from one of my members. I just kind of wanted to put that out there. So this from Pam. She said, sending you a quick note of thanks that you can maybe pass along to Larry for all his fabulous teaching through the years. I truly have enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and the other ways to trade than Larry. So that I thought that was a really nice summary of what I try to achieve. And so here's kind of what we're going to go through in the course, kind of breakdown of the course, which will start next Saturday. So we'll do, first, I always like to start off with the option Greeks that are going to be, key importance for selling strategies, options type strategies, credit spreads, etc. How the option delta and trade probabilities work. We'll go more into that again. And then I'll go into my selling guideline and rules. You'll get the rules that I use for these types of trades. So these will be a handout that you can keep, look at and follow. And then pricing your options, how it works, the effects of time decay and volatility again. And then we'll go through price target mapping and standard deviation that we'll use that to set up these types of trades. But again, you're going to get my price target mapping course as a bonus. But in the course next weekend, we're going to go through every trade I do before I ever put it on. We do this price target mapping on the trade. And then we'll go through the best markets and trading timeframes for if you are doing credit spreads. Then we're going to go through how to use the cycle reversal indicator and the extreme range band to tell us when it's time to sell. Then part two, we'll get into the 4 kind of different option selling strategies, the ones that we're going to use. And then we're going to go through, when and then how to use these for, income and profit. So we're going to go through step-by-step guide on how and when to set up and use the bear call credit spread, the bull put credit spread, the iron condor. So we're going to spend a lot of time on that. And then when to use that bear call credit spread versus a bull put credit spread of the iron condor. So what market conditions are best for these credit spreads, which ones to then use, what are the perfect time frames, what's the best time frame, go out week, 2 weeks, 3 weeks for these trades, and then 5 really good rules for to follow for using credit spreads. So I like to always have a lot of rules and systems for these trades. So you'll get a lot of really good, trading rules and things that you can use. And then we're going to go into the long condor. These are, really a big part of our trading. Love to use these a lot. So we're going to go through, exactly when to use the long condor option spread. Again, not to be confused with the iron condor. So we do a whole lot of these. And these are great low capital risk strategies that give you potential trading results of 200% or greater. They give you positive theta, so we'll go through what that is, how that works, no time decay. We'll go through the big advantages of the condors and what they have over the other option spreads and how to trade them. Step-by-step guide for doing these spreads, which is combining the vertical spreads together to construct. So we can do these again. We can leg in, leg out, or do it all at once. And then how we can make adjustments to reduce our capital at risk using what we call the broken wing long condor, or even what we call the ratio condor. So you're going to spend a lot of time on these two. And then part 3 is hedging. Okay, so it's a perfect time. You better learn how to hedge now. These markets are now entered the super phase of extreme volatility going into end of September into October. So perfect time for this. So a complete guide on hedging with options, how, why, and when to use credit spreads to hedge your core trade, to hedge position out, how, why, and when then to use the condor spread as a hedge, and then 5 ways to hedge a credit spread. So we're going to go, I'll show you if you do credit spreads or just starting out with credit spreads, I'm going to show you 5 different ways to do your hedging and still make money even if you're wrong. And then you're going to, tricks and strategies. We're going to go through, how assignment risk works, what you need to know about that, option expiration risk, auto exercise assignment. So then you'll get a trading club library, a library too. So, I always like to put trades in a library of trades because then you can go back and look at the trades, see what the winning trades had in common, how they work. And a lot of times that really helps you to understand and learn. All right. So again, use that link, and then you're going to get the special bonus, that cycle reversal indicator. All right. So, it's based on a percentage range band. This is a really good tool that I came up with, and I've got this available for Thinkorswim, TradeStation, or TradingView. You can have one platform or all. You're going to then get my extreme range band indicator that I kind of went over here today. Thinkorswim, TradeStation, eSignal, Ninja is where I've got those. And so your cycle reversal, extreme range bands, we covered that. So that's what you're looking at there. Then this is such a great course. You're going to get this, and just completed this one. This is all new. My Fibonacci price target mapping course just finished this. So this is a step-by-step Fibonacci course that not just Fibonacci, this goes through and combines Fibonacci price analysis with moving averages, price action, standard deviation, and unusual option activity. So combination of these 5 things create what I call this target mapping for targeting profit targets or defense targets. Super great course, and so very vital to all the trades that we do. And then you're going to get a 30-day trial membership. You can start this whenever you want. If you do the course package with the alerts, you'll get this for 4 months. And so it has the virtual trading room every day, 9:30 to 10:30 Eastern, Monday through Friday. Come in. If you have a problem with the trade, come in and we'll help you. I'll help you work through the trade, whatever you need. Do a daily video newsletter. We have a trading video archive. We have a weekly Q&As. And there's an educational vault within the members area for educational stuff. 60% discounts on all courses and software. So then if you went to anything on my site, you can get a 6% discount on everything. So if you come in here and you want something else that I have, like all my courses are pretty much geared around options. So if there's another course in here you wanted to purchase, like Ultimate Option Guide course, whatever, you can come in here, click, come down to the payment link here. It's $5.97. Put in your members code and you're going to get 60% off. So put in your promo code here. This will drop that down by 60%. So you can get that, or any of my software, you can do the same. All right, so I've got a lot of great trading tools in here, scanners, indicators. Now you're going to get these 2 indicators, 2 of my favorites as a bonus. You're going to get the cycle reversal indicator here and extreme range band. Okay, so those are bonuses, but anything else, you get 6% off of those. All right, so that's what you're going to get there. And one thing I like to point out, Jay, one of my old members, longtime members, said, reading books is fine, but seeing the actual option trade setup makes a huge difference. So that's what you'll get in the trading room. And then bonus 5, we'll do a follow-up Q&A. That'll be on Tuesday. And then plus you get the virtual trading room for 30 days or 4 months if you do the alert service, and my option trading tutorial. So this is another option trading guide, 60-page guide with videos on the Greeks, delta, gamma, theta, option pricing, standard deviation, option delta. So really getting you beefed up for that. And then my classes. Yeah. Oh, yeah. If you took this something like this in 2017, yeah, huge difference. Yeah. Big difference. Yeah. I mean, yeah. Let me just checking out. Yeah, you can delay the alerts as long as you want. Yeah, Paul. So if you do sign up with the alerts, you can turn it off, turn it on and off. You can do it yourself. Okay, so you can manage your time, and so you don't, you're not going to be, use your time against you. So if you have, you're in Kazakhstan and you're, gone for a month, 2 months, whatever, you just stop your alerts and come back and start them again. Okay. So here's a look here at the alerts. We've had really great success. So here's from Dan. He said, you're very diligent and totally thorough with your analysis. That is the foundation of the success of alerts. I paid for the subscription with the first, this is a good one because a lot of members do it. First 4 trades I took with you when I was just learning how to trade options. So he was just learning, but he paid for the whole alert service by, the text alerts that I sent out. So they're very descriptive. Here, I'll show you what they look like real quick. And these, we use a service called Telegram, and these go out they go out within seconds. So here's one we did. Here's one we did Friday. So we did, this is a short trade. We started this Friday. You can see here September 6th. This was a great trade. So we did this first thing in the morning. New SPY retracement failure short. It was trading at 549. Sent this out first thing in the morning, about 8:30, 8:38, right when the market opened up. Give you a description. Said testing the 50 daily moving average for a downside break. Daily negative momentum plus a momentum downside cross, which is another indicator I use. Gave you the targets, target 1, target 2, and then I give you the trade. Buy a vertical SPY debit spread, 248, 243 put debit spread at $1.35. We ended up getting it at $1.30. And then I'm just updating you, during the day. If you need to do anything or just telling you where the trade is, here's just a lot of updates. Here it is, it's SPY trading at 543, filling the gap. If long, currently up around $130 per spread. Here it was at the end of the day. So, just constantly updating. Here's SPY, trade around 539. Currently up around $230 per spread, 176%. If long multiple contracts, lock in some more profit, things like that. Oh, great. So here's one of my members here that took it, made almost max profit on the SPY trade again. Thank you. And then Scott says it'll be the best investment that you'll ever make. Great group of traders as well. So when I send out, like I said, a lot of members just do their own thing, but I'll always give you a suggested option trade like I showed you. Entry level targets, profit targets, unusual option based on the price target mapping. What option series to use, stop loss levels, any adjustments I send out constantly. Then we do, the video nightly video. I do a video review of the trade. That's also with the video newsletter. You get access to our weekly Q&As for the next 4 months, live and recorded, access to virtual trading room every day during the week, 6% discounts. So here's breakout credit spread trade alerts. Now this is one of the first alert services I started. This was started, I think this was the first one I started back in May of 2019 and through current. So don't do a whole lot of these because we have so many other different ones, but we've had 169 closed out, 123 winners, 6 break even, 40 losers, 76% win rate there. And here's the one that we just did on Friday. This was the SPY short. We did this along put debit spread. These are very detailed. You can see new SPY. I just showed you that. And then, showing you what to do, when you need to, do any adjustments, take profits. So constantly updating you on that. So here it was trading right there. We did this first thing on the open, and then we were taking profit down here into the close during the day. So did this as a put debit spread, and this was, you can see, bought the 248 put, sold the 243. This was for the 10 September, so that's a Tuesday expiration. Spread with $5, total risk $1.30, 130 bucks. Potential max profit 370, 284% return, and that's what we should get if we close here where we were Friday. But this was a great trade, 1 day trade. Went out right here. We were taking profit all through the day. It's traded at 539.89. This went from $1.30 to 361. So it was up $231, 177% return. So that's one that we just did. And then here's another one we did recently. This was a QQQ short. Again, this was doing a put debit spread. This was on the 2nd of August. It's trading at 448. We ended up getting out on the 5th, 426. I'll just kind of flip through these, but the same, very descriptive on what to get in, how to do it. So here was where it was trading. Got out here the next day. So put debit spread here, 445, 442. Spread with $3. Total risk 88 bucks, 88 cents, 88 bucks. Potential max profit 300. Spread with lesser cost 212, 240% return. This was max profit, 240% right there. Now here, now we do a lot of these as well. These are butterfly and these are long condors. Okay, so here's the update here. So through started back in May 2019 through yesterday, we've had 183 trades closed out, 129 winners, 13 break even, 41 losers, 78% win rate. Now these have potential to make 25 to 1. Okay. Now these will be the lowest risk trades, the butterflies and condors, maybe risk of 50, 75 bucks, but potential to make 2x up to 25x on these types of trades. So it's a great addition to anybody's portfolio. Here's one we just did. This was on CRM. This is one that One of our members just said, it was a good call to get out early. We got out of this on Thursday because it looked like the market was going to crater. So we went ahead and closed this out and made a decent profit, but it didn't make our max. Thank you very much, Michael. Yeah, well, send me some information on the format that you'd like to see. Okay, please do. Send me a format. Here, send it to me, Larry. Yeah, I send these out, man. The markets are moving fast, so you've got to understand that these things are. I'm going through, jumping through a lot of hoops. I'm having to pull a lot of levers. So CRM is one we did here. So you can just see, we go through the description here. It says new CRM retracement failure short, trading it when we set it up on the 30th of August, trading at 251.50, negative momentum. I got through a lot of things why I set it up. And then here it was on the 5th. So then we went ahead and at the end of the day, the market looked like it may break hard, right? We had that non-farm payroll on Friday. So I said it was trading at 245.60. If long this put spread, moving towards the 6 September 245 short put strike could overshoot to the downside tomorrow. That was going to be on Friday, which it did. So close trade balance for profit. So we ended up just closing this out for not max profit, but a decent profit. And here's the trade setup. So here was CRM. We got in right there, closed it out right here. And then you can see the next day it did break hard to the downside. So did this is what we call a condor, put condor. So long the 252.5, put short the 250, and then sold against it the 245, 42.5. We did this as the spread. But again, in the course, I'll teach you, sometimes we leg in, leg out. Total risk of the trade was 73 cents or bucks, spread width 250. Potential max, if it went out here, was 177, 242% return. But we take what the market gives us and we close the trade out before the close. And we ended up making $70 per spread here. Still a good return on our capital at risk, right? So it's all about risk. So we had a risk of 73 and felt that there was a good chance that this thing could crater to the downside, which it did. So went ahead and sent out that alert to close it out. So it's trading at 246.76. So the spread was at 143. So 70 bucks, still 95% return, nothing to sneeze at there. And go on to the next trade, right? So that was that. Now here's Oracle. This is one we did not long ago as well. Here's another. This was a long call condor. I'll just flip through these. I don't want to take up too much of your time. I'm just showing you the different ones. Yeah, sure. Here's the code. So again, here, use that powercycletrading.com/special, and then use the code small cap sell, SELL 15. Okay, 15% off. So use this link here and then click on that link and then use sell, make sure it's small cap 15, and that'll give you that discount. All right. So here's Oracle. We went long Oracle and out the, here I'll just kind of run through this trade. So here's the long setup right there. So, all my indicators, I use these, my scanner to pick out all these trades. And here's that cycle reversal, which is an indicator you're going to get. My momentum's positive. Bought it right here, breaking through a Fibonacci level, closed it out here. So it was in when we in at 137.50, out at 140.52, basically there. So this was long the 137 call, short the 140, and then the 142, 145, spread $90, risk, spread width 300, lesser cost, potential profit 210, 233% return. So we got out a little bit early, didn't want to wait till the very end because, you know, these things can bounce all over the place the last day. So close this out on the 22nd before the expiration was the next day. Just, you know, didn't want to take that risk of this thing, you know, going up or down. So I closed out here. So this went from, this was trading at 233, spread cost 90, 143 bucks per spread, 158% return. And here's one to the short side. I'll just flip through. This was ConocoPhillips because this is a big part of what you're going to learn in the course, these condors. So here was one to the downside, got out here. So we had this a put condor, so the 112, 110, 109, 107. Look at the risk on this trade. We had this defined risk of 48 bucks, 48 cents, spread with $2, 200, potential make 316% return. The short trade. So got out right there. So the spread had blown from 48 to 154. So made 106 or 220% return. Now these are a lot of fun. This is another category. You know, these are the lotto ticket butterflies and calendars that we'll do on for pinning. Here's one we did on Tesla, which was amazing. And this one we did back in February. So this one actually pinned right at our strike of 200. So this thing was actually up 1,925% return. So the setup was, we got into this for $12. So I'll just kind of read through here, but this was the alert sent out on the 8th and then out on the 16th. So here was trading. We had a target here of 200 right there, and this thing nailed it at 200. So we had this trade set up. This is our pinning binary butterfly pinning trade alert. So it's trading at 189.35 when we set it up. So we had this butterfly, $2.50 wide butterfly, 12 cents. $12 was our max risk. If everything went wrong, we lose 12. If everything went right, we could make $238 per spread. That's a 1,983% return. And everything did go right. This was just an amazing trade. So this then ended up pinning, went right at 200 right there. So it was up $238 into the end of the day, 1,983% return based on that risk of 12 bucks, right? Here's another one we did just recently on GLD. This was a call butterfly pin. And again, new GLD long binary call butterfly, blah, blah, blah. And we set this one up. We originally got in for 24. We were targeting 125, but then adjusted it to the 130 strike. So, and got out the 16th. And this one had potential to make $231 per spread or 1,925% return. And so we got in right here, got out right there. We adjusted this to the 230 butterfly. So this is what we ended up with. This one turned out pretty good as well. So we had the 227 call, 230, 233, total risk $29, 29 cents, potential profit 300, spread width less the cost, potential to make 934%. I've got to change that slide. That was wrong. That was not right. So I have to go back and change that. And here's where it went out. So we basically got out during the day. It was trading at 230.47. So it was up $203 per spread on that risk of 29, 700% return there. And then here are just a couple calendars to show you calendar dot. We do, you'll see here, these are probably the most that we do. You know, we do a lot of these just based on whatever the market condition is. These tend to be a lot of trades that we do. So we've had 297 trades closed out, 217 winners, 16 break even, 64 losers, 78% win rate, again, unaudited. Here's one we just did. This was a great trade. We just did this one last week. This was on ConocoPhillips. This was a short trade we did. We set this up on the 4th and we got out, got out of most of it on the 6th and did adjustment. So this turned out really good. So this trade, then we ended up taking some profits yesterday. It was trading at 106. We got in at 109.85. We were up $225 per spread yesterday, 145% return. So here it is, new ConocoPhillips retracement short, trading around 109.85, daily negative momentum, downside cross. target 1, 108, target 2, 106. It nailed it 106. And then we did an adjustment here yesterday. We adjusted this to roll the spread for more potential profit, the way the calendar works. So got in right here. Took profit yesterday on part of it and then adjusted the balance. So that's where it was yesterday. So this turned out great. And so here, this thing nailed it almost to the penny right here. We were targeting on the first target was 106, and here it was right into the close, 106. So the spread went from $155 and it was going at 380. So, you know, you're taking profit at different points, but this is where it was at the close. So this was up $225 per spread on that risk of 155, 145% return now. But we're still in the trade. So what we do is we'll take profit on part, and then we're looking for a bigger move down. So we adjusted the balance of the trade, so we're still in it. And so now what we've got is, let me show you. So now we've got this adjusted trade where we're long the 20 September 109 put. That's what we were originally long, but we've adjusted the price down because we took a little profit on the short strike yesterday. And then we sold the 13 September against at 104. So we've widened the spread out. So now we've got this trade on for adjusted price of $82. And then because we got a huge premium when we sold the 104 strike. So now we're in at 82. And just right here where it was yesterday, you can see it went out, it was up $225, 274% return. But this one has potential to make a lot more. Let me show you real quick. Let me just pull up ConocoPhillips and you'll see. So I send these out just based on what I think is the best option strategy based on the market environment. So this one we did, and so we set this up, got into it right here on the third, I guess, right here, the fourth, got it right here. This is a momentum cross, that orange arrow. And then see there's more potential. So next level, we're looking at 105, which it almost hit, and then back down to that prior low 102. So what we did here is we adjusted this trade. So now we're still in the trade, but we've adjusted it. We're along that 20 September 109, short the 13 September now 104. So $5 widespread 82. Now, if we were to go out at 104 next Friday, this thing will be at $430, okay? So just a really, great strategy to really, try to milk it for a bigger move to the downside. So that's a look there, and that's pretty much it. Here's one other one just to show you. This was one that we did on Boston Scientific. This was a call counter diagonal. This one turned out really nice, got in right there, got out right there. Beautiful trend to the upside, momentum, everything same every time. So ended up with the adjusted trade here, just long the 30 August, short the 23. Going out here, this was up on the 19th, it was up 102. So we went from 135 to 238, up $103 per spread, 76%. But then we adjusted the balance of the trade, and these are pretty cool. We adjusted this into a condor. And so at that adjustment, this was on the 22nd. We were up, it went from adjusted price of $60 to 178, so up 118 or 196% return. So that's just a look at what you can get. And just if you have any questions, let me know, but make sure to use that special link and then use that promo code SELL small cap 15. Any other questions? Okay. Yeah. Okay. So that's kind of where we are. So it's a really good value. So hopefully everybody will take advantage of this before the time runs out on this offer. Yeah. So here's the alert link. Here's okay. So click that. Okay. So now click on that link. okay? And then come down here. So if you want it with the course package 1, right here, you see everything you're going to get. So click on buy and then put in sell 15. Then you'll get a discount of 50% off. If you want it with the alerts, come down here, click on course package 2, and then come down here. It shows you pretty much everything you're going to get. And then $597 is what the price will be, after today. And then if you want this, there's a to pay if you want it. Okay, you can click that. Now, if you want to add the indicators, you can do that. So add that if you wanted to, let's say. So then put in your promo code SELL15. And then you'll get a discount off of all that. Or if you did it, just the other way, you'll get it. This will be 507. Okay, so sell 15. Sell 15, okay? Okay, you're welcome, Shams. All right, so that's pretty much everything. And then next week, we've got CPI on Wednesday, PPI on Thursday. So there's always something to navigate. So again, that's why, it's very, very beneficial for you to, I would think, to be in my alert service. So then you don't have to do all that stressful thinking about trades and all that stuff. I'll do it for you. All right, well, I'd like to say again, thank you everybody for being here today, and I'm looking forward to next weekend. And this course is going to be more focused on the condor and credit spreads, okay? Not going to be, looking at the butterflies. This will be just more on hedging, using credit spreads, and more focus on the iron condor, long condor, and hedging. Okay. I mean, there's always going to be some overlap because options are options, but this is going to be geared towards more focus on the hedging side and that condor spread. All right. Well, again, thank you everybody for being here, and have a great rest of your day and weekend. And I appreciate the comments and everything here today.